G'day everyone. Here's an example of exactly what we are helping family businesses across Australia avoid. Been dealing with a new client recently, and unfortunately, through their father's estate, they've got an unintended tax bill of just over $600,000. And the reason for that is because a lot of assets were transferred via the will rather than dealing with them via a succession plan and dealing with or tapping into tax concessions and so forth to avoid such a tax bill. My name's Chris Mulcahy from Future Accounting. Our goal is to empower family business across Australia, and we're on a mission to preserve and protect the equity that's been built up in families' businesses over generations. In this case, no one really asked Dad about his will. It was deemed to be disrespectful. Everyone had assumed that everything was going to work out all right. Mum had died a few years prior. Assets just transferred from mum to dad. Um, no one really thought much more about it other than being told everything was under control. It's all sorted out. Don't worry, everyone's been treated fairly. So there was an assumption across the siblings of how it was all going to play out, and everyone seemed to be in agreement. Um, but yeah, look, unfortunately, there was one paragraph in that will that really triggered this tax bill and could have been dealt with and avoided with a little bit of planning. So it just goes to show a will is definitely not a succession plan. Um, Relying solely on a will to transition wealth is dangerous for many reasons. One, from a tax perspective. Two, potentially, you're setting yourself up for estate challenges. And I guess there's that real possibility too of death duties or inheritance tax being introduced at some stage in the future. And the other probably frustration when you come across these types of scenarios is that there are some fantastic and very valuable concessions from a taxation perspective, capital gains tax particularly, as well as stamp duty for farmers that enable assets to be transferred amongst generations or into structures that allow the transition of assets safely and securely between generations. And we can do that without paying capital gains tax or paying stamp duty. So when you come across situations like this, it's very frustrating because it well and truly could have been avoided. How much longer these concessions will be available, who knows, as we all pretty much well aware that governments at all levels need to raise additional revenue. These concessions are probably easy targets to be wound back or be removed completely. So our recommendation is use them before we lose them. They're valuable, and with other family businesses and particularly farming situations that we deal with, there's a saving or a preservation of equity of somewhere between 500,000 and 2.5 million, depending on the circumstances. So well and truly worthwhile looking into. Um, so there's a there's a link below. Click on that. There's a bit more information, as well as our 3Ps. There's more information on how to preserve, protect, and prosper for your family business. But thanks for watching, and feel free to reach out if you need any further assistance. Thank you.